When people talk about the market, they could be talking about 100 different things: stocks, forex, crypto, commodities, even bonds and real estate. Each of these is a financial universe with its own rules, risks, and opportunities. But how do they actually work, and what makes each different? In this video, we're going to explore the major types of financial markets, how they function, who participates in them, and what makes them tick. Let's start with the stock market, the one most people are familiar with. Stocks represent ownership in a company. When you buy a share of Apple, you literally own a piece of Apple Incorporated. The stock market is where investors buy and sell these shares, and it's often seen as a barometer of the economy. There are two main types of markets here: primary and secondary. In the primary market, companies raise money by issuing shares through an IPO, an initial public offering. In the secondary market, these shares are traded between investors on exchanges like the New York Stock Exchange or NASDAQ. What makes the stock market interesting is that it reflects both fundamentals like revenue and profits and human psychology, fear, greed, and hope. That's why markets can go up on bad news or crash despite good earnings. Next up is the foreign exchange market, or Forex. This is the largest and most liquid financial market in the world, with over 7 trillion traded every single day. In Forex, you're trading currencies like the US dollar, euro, Japanese yen, or British pound against each other. It's always a pair. One currency is bought, the other is sold. Forex is decentralized, meaning there's no central exchange. Instead, trading happens 24/5 across banks, institutions, hedge funds, and retail traders like you and me. It's heavily influenced by macroeconomic factors, interest rates, inflation, politics, and even natural disasters. Unlike stocks, Forex traders often use high leverage, which increases both potential gains and risks. It's fast-paced, and small price movements can be significant due to the high volumes involved. Now let's talk about crypto, arguably the most hyped and misunderstood market today. Cryptocurrency markets revolve around decentralized digital assets like Bitcoin, Ethereum, and thousands of altcoins. These aren't tied to a country or central bank. Instead, they run on blockchain technology. Crypto trading happens on digital exchanges, Binance, Coinbase, Kraken, and it's open 24/7. Prices can be wildly volatile, which is an opportunity and a risk for traders. Crypto isn't just about trading, it's a new way of thinking about money, finance, and ownerships thanks to innovations like smart contracts and decentralized finance. Still, it's also unregulated in many places, which opens the door to fraud, pump and dumps, and manipulation. Commodities are raw physical goods like oil, gold, wheat, and coffee. They're traded on commodities markets through contracts, often futures contracts, which agree to buy or sell a certain amount at a set price on a future date. These markets are crucial because they help stabilize prices for producers and consumers. Airlines, for instance, might use oil futures to lock in fuel costs. Gold is often seen as a safe haven asset when stocks are crashing. Commodity prices are influenced by supply and demand, weather, geopolitics, and even speculation. There are two kinds of traders in this market: hedgers, who are trying to reduce risk, and speculators, who are trying to profit off price swings. Beyond those, we have bonds, which are essentially loans. When you buy a bond, you're lending money to a government or corporation, and in return, they pay you interest. Bonds are generally considered safer than stocks and are a key part in diversified portfolios. Then there's real estate, both physical and digital. Traditional real estate involves buying property, residential, commercial, or industrial. You earn through rent or price appreciation. Meanwhile, newer models of real estate investment trusts let you invest in real estate without actually owning property. There's even a growing market for digital real estate in metaverses, though that's still largely speculative. So how do these markets stack up against each other? Stocks are ideal for long-term growth and are accessible for beginners. Forex is high risk and high speed, better suited for experienced traders. Crypto offers innovation and volatility, great for tech-savvy risk traders. Commodities are grounded in real-world demand and can hedge against inflation. Bonds offer stability and steady returns, and real estate provides tangible value and passive income but requires more capital and management. Each market plays a different role in the economy and in a well-balanced portfolio. Understanding how they're all connected is the first step to becoming a smarter investor.